Good morning, everyone, and welcome. I call this meeting of the Ncra Board to order. The first item on our agenda today is the Ncra's 2020-2021 budget. Staff presenting Rendell Jones, Chief Financial Officer. Welcome, Rendell.
Good morning.
Good morning.
I'm here to present for your approval the proposed Ncua 2020 and 2021 operating budget, capital budget, and share insurance fund administrative budget. The total funding presented in these three budgets increases 1% from the 2020 levels approved by the Ncra Board in November of 2018. The combined budgets for 2020 total $347.4 million. The 2020 operating budget is $315.9 million and 1,180 full-time equivalents, or FTE. The 2020 capital budget is $25.1 million. And the 2020 Share Insurance Fund administrative budget is $6.5 million and 5 FTE. Last month, I presented the Ncua draft 2020 and 2021 budget justification document in a public board meeting as required by the Economic Growth, Regulatory Relief, and Consumer Protection Act. The meeting was live streamed on the Ncua website. The draft budget was also posted to the Ncua website and published in the Federal Register on November 1st, 2019. At the public board meeting, 3 independent national associations presented their views on the draft budget. In addition to the 3 oral presentations at the public board meeting, Ncua received 28 written comments from 26 organizations, including from the associations that presented at the budget hearing. These written statements are posted on Ncua's website. The 2020 and 2021 budget proposed for your approval has been updated to respond to actionable comments collected from the public. These revisions are summarized in the board action memorandum. In addition, we revised the estimates in the draft budget downward for payments to the Federal Financial Institutions Examination Council and other modest revisions to estimated compensation costs. This reduces the draft budget proposal I presented last month by about $330,000, lowering the overall increase to 3.8% over the 2019 budget. As I briefed last month, about 1.6% of the increase, now at 3.8%, is due to an increase in the mandatory contributions that all federal agencies must make to the U.S. Office of Personnel Management for the Federal Employee Retirement System. We've also revised the draft 2020 operating budget estimate upward by about operating budget estimate upward by about $2 million to reflect additional retirement system contributions based on new estimates for 2021 provided by the U.S. Office of Personnel Management and the Office of Management and Budget. The projected increase in 2021 is now at 3.8%, the same as the increase in 2020. In addition to funds presented in the budget justification, we estimate that approximately $2 million in resources made available for prior year expenses will not be used before the end of 2019. These funds can be used in 2020 for other expenses. Let me now briefly summarize the comments received from the public and the revisions we made in response. Of the total comments received, 10 submissions were general comments and suggestions about how to improve Ncua's budget or its programs, and 18 submissions more specifically addressed Board Member Harper's proposal to add additional staff to the Ncua Office of Consumer Financial Protection in 2020. Of the general comments and suggestions, the majority of the comments relate to Ncua's operation and program execution. I will provide these comments directly to the appropriate senior executive responsible for the relevant offices and topics discussed in those comments. Several comments noted improvements in the draft budget compared to previous years, including the inclusion of an economic outlook, explanations about financing and the overhead transfer rate, and efforts to modernize the agency's information technology system. One commenter recommended that the Ncua use cost-benefit analysis to make budget decisions and include the results of such analyses in future budget documents. Cost-benefit analysis is a useful tool for evaluating many policy decisions that impact the public directly, and the Ncua already conducts cost-benefit analyses and rulemakings that have a significant economic impact. As explained in the updated discussions on page 25 and 26 of the budget justification, Ncua uses an enterprise risk management approach to evaluate its responses to risks and opportunities, and the budget includes several investments made as a result of enterprise risk management reviews conducted in 2019. I look forward to the opportunity in 2020 to brief the Ncua board about the agency's ERM approach and program. Another commenter asked for more detailed explanation of the underlying dynamics that resulted in the 2020 increase in the overhead transfer rate, which was slight. The Office of the Chief Financial Officer worked closely with the Office of Examination and Insurance to update the discussion on pages 58 to 61, which now provides more detailed explanation about the variables and dynamics that drive changes to the OTR. Several commenters noted that the budget justification should provide more description and justification of growth in the contracted services portion of the budget. The Office of the Chief Financial Officer plans to provide the public with additional information about the agency's competitive contracting process on the budget and strategy page of the Ncua website in response. One commenter asked Ncua to present additional expenditure data in budget tables and to include the annual count of credit unions on charts presented in the budget justification. Currently, on the budget and strategy page of the Ncua website, we already publish monthly reports on actual expenses from Ncua's various funds, which is a more timely and accurate presentation of the agency's spending and financial position. With these monthly reports, expenses are generally presented in the same cost categories as the budget justification. In addition, I make an annual presentation at the July board meeting, providing an analysis of expenses incurred through the first half of the year and updated budgetary projections for the remainder of the year. Finally, one commenter asked why state examiner computer lease costs increase in the 2021 budget for the Share Insurance Fund administrative expenses. And the budget justification was updated on page 54 to explain how the Ncua expects to solicit for and award a new contract in 2021 for laptop computer leases, and how more of the costs of the program are expected to be incurred in the first year of the contract, accounting for the difference that was requested by the questioner. A hallmark of our budget process is to invite public review of our budget, and we will continue to use this feedback to explore ways to improve the budget process and the materials made available. Next, I'd like to discuss the primary means by which Ncua finances. To promote transparency about Ncua's financing, pages 57 through 62 of the updated budget justification include a discussion of the methodology for calculating the overhead transfer rate and the operating fee. And as I previously noted, we received comments asking us to improve the discussion about the variables and dynamics that drive the year-over-year changes, and we have done so in the revised budget justification. The financing section of the justification explains how Ncua's operating budget is financed and the methodology for the OTR and operating fee. Ncua's annual expenses are funded primarily through fees paid by federal credit unions and transfers from the Share Insurance Fund through the OTR. As the annual budget is developed for board review and approval, the approved methodologies for calculating the OTR and operating fees are applied to determine the amount of the budget that will be financed by each. The board delegated authority to the Chief Financial Officer to administer the approved methodology for calculating the operating fees and set the fee schedule. There is no change to the underlying methodologies for computing the OTR and the operating fee. Rather, the changes in assessment results from re-estimated overhead transfer rate and from indexing the fee schedule to projected asset growth consistent with the board-approved methodology. Worksheets that show the specific steps used to determine the operating fee and the scale for rates charged to different sized credit unions are included on pages 63 and 64. The OTR percentage as presented in the draft budget justification has not changed. The final 2020 overhead transfer rate remains at 61.3%. This is an increase of 80 basis points from the 60.5% rate used for the 2019 budget. The residual 38.7% of the 2020 budget will be collected through the operating fee. The operating fee rate charged to federal credit unions will increase by an average of 1.13% as compared to 2019 and is an 8 basis point reduction from the draft budget because of downward adjustments in the operating budget that I mentioned earlier. The operating fee will be assessed on federal credit unions based on the projection of the year-end assets. And based on the June 30th, 2019 call report data, annual asset growth is projected to be about 5.6% at year-end. As shown on page 61 of the budget justification, federal credit unions cover about 70% of the cost of Ncua's operations, while federally insured state chartered credit unions pay about 30%. Federal credit unions with assets less than $1 million are not assessed an operating fee. For federal credit unions with greater than $1 million, the Ncua establishes a 3-tiered scale to compute the operating fee charged, known as the assessment scale. The dividing points on the asset scale are adjusted upward on an annual basis by projected asset growth, and the dividing points are indexed annually to preserve the same relationship of the scale to the applicable asset base. And this is the exact same methodology used in prior years and approved by the Ncua board. To conclude my remarks, I would like to read the specific recommendations provided in the board action memorandum and request that you approve. 1, the 2020 operating budget of $315,883,000 and 1,180 FTEs. The 2021 operating budget of $327,973,000 and 1,180 FTEs, and that $2 million from unspent prior year balances, of which $1,750,000 will be reallocated from past year's capital budgets and is available for expenditure from the operating fund in 2020. The second item is the 2020 capital budget of $25,076,000 and the 2021 capital budget of $25,205,000. The 2020 Share Insurance Fund administrative budget of $6,450,000 and 5 FTEs, and the 2021 Share Insurance Fund administrative budget of $6,932,000 and 5 FTEs. Thank you for the time this morning, and I'll be pleased to answer any questions that you have.
Thank you, Rendell, and thank you to your staff as well for all the hard work that went into developing and revising the 2020 and the 2021 Ncua budget. As we heard at the public budget meeting last month, the Ncua's budget process is unique among financial regulatory agencies for its transparency. We welcome and value the important comment letters from interested stakeholders. I appreciate the staff's efforts to find ways to refine estimates for projected 2020 payroll expenses, as well as to incorporate some of the feedback that we received on the draft budget. As noted by one stakeholder at the budget briefing testimony last month, and I quote, "The Ncua proposed budget seems reasonable in the context of approximately 2% inflation against the backdrop of a 6% increase in credit union operating expenses overall." End quote. Based on feedback received from the briefings and comment letters, I was pleased to see that the final budget before us today is slightly lower than the budget presented last month. It reflects a 3.8% increase year over year, and I'd like to note that 1.6% of that growth is a mandatory contribution required by the Federal Employee Retirement System as dictated by OPM. Stakeholders should know that we do take the feedback seriously and work diligently to incorporate suggestions when possible to make the budget process and this final document stronger and even more transparent. In terms of the dedicated consumer compliance program, an overwhelming majority of those commenting on the budget were opposed to it. The strategic objective 2.2 for the Ncra includes, quote, "enforcing federal consumer financial protection laws and regulations and federal credit unions," end quote. The Ncua's annual performance plan describes the many activities that are undertaken in furtherance of this objective. Ncua has tools to ensure that credit union member owners are well protected. Our Consumer Assistance Center provides consumers a means to voice their concerns about their interactions with credit unions. This center identifies trends or problem areas for compliance and focuses our examinations and training efforts on these areas. These trends, coupled with findings from our Fair Lending Supervision Program, input from field staff, and discussions with our consumer compliance counterparts, help focus our examination resources to target compliance areas exhibiting a higher risk profile. At this time, I am not convinced the credit union system needs a dedicated consumer compliance program. With that said, I now have a few questions for you, Rendell. Based on the feedback we've received, what changes do you foresee to the budget process moving forward?
I think most of the comments that are related to the budget are really about additional disclosures and information where we could describe in a bit more greater detail some of our processes. So, for example, around contracting. So we can and will include additional information in the budget justification about that and post information on our website so stakeholders will have a greater understanding of how we execute funding related to contracts. And we will do that before the next budget cycle so stakeholders don't have to wait a year to get that updated information.
Very well. And just on the subject of contracting and all of our supplier spend here at the agency, I noted this in my congressional testimony. I am very pleased to see this agency support Dodd-Frank Section 342 through the efforts that we're doing with the Office of Women and Minority Inclusion. To that end, very pleased that over 44% of our supplier spend is to diverse and minority contractors. So I'm very happy to know that we're going to continue to fine-tune the contractual process, but very pleased already that we are making great inroads in supporting minority vendors and suppliers. A significant cost driver to the 2020 budget increase is the increase in charges that the Office of Personnel Management charges the Ncua to fund federal employee retirement costs. What do you anticipate happening with respect to these costs in 2021?
So we expect them, based on a notice we received from the Office of Management and Budget, we expect them to increase again. So in 2020, the increase was about 230 basis points, and it's anticipated to increase another 130 basis points in 2021 for just increased contributions based on actuarial adjustments to the retirement system of the government.
So with that being the case, we don't know when there will be an end in sight in terms of those adjustments no longer being required.
Not now, we do not.
Very well. Well, thank you. I have no further questions. And now turn to Board Member Harper.
Thank you, Rendell, and thank you for your presentation. From my perspective, there are a number of good things in the 2020-2021 Ncua budget, including pay comparability for the Ncua staff that includes merit increases, funding for the new merit examination system and training for examiners who will use that system, funding for additional cybersecurity policy staff, and funding to reimburse Ncua supervisors for a portion of their professional liability insurance, which is consistent with what other financial regulators do, as well as appropriated agencies. But I also have concerns about this budget and today's meeting. In fact, today's meeting is really one in which we will delay and do little. We will delay implementation of the risk-based capital rule yet again, and we will do little in this budget to strengthen consumer compliance reviews. Accordingly, I will vote against the budget because it does nothing to strengthen consumer financial protection. In its comment letter on the proposed Ncua budget, Americans for Financial Reform Education Fund, a group that represents more than 200 civil rights, community, consumer, labor, small business, faith-based, and civic groups, makes the case simply and elegantly. Strong consumer protections and robust supervision of financial institutions are vitally important, both for our individual borrowers and for the health of the whole economy. I couldn't agree more. Yet, for more than 3 decades, the Ncua has focused its examination program primarily on safety and soundness reviews. This policy worked well when the Ncua oversaw a large number of small credit unions serving a limited field of membership with only a few basic financial products. But today's credit unions are larger and more complex, with 319 credit unions exceeding $1 billion in assets and having 73 million members. As the National Community Reinvestment Coalition noted in its comment letter, the lack of change implies that the Ncua is not keeping pace with the growth in the number of large credit unions and the changing dynamic of the industry that it regulates. Once again, I couldn't agree more. With respect to large, complex credit unions, the time has come for us to put continuous improvement into practice. As the largest credit unions continue to grow in size, the time has come for the Ncua to evolve its consumer compliance program. What is more, the Ncua's current method of examining for compliance with consumer financial protection laws in a credit union with total assets of $10 billion or less differs from other depository institutions regulators, which complete regularly scheduled, risk-focused consumer compliance exams and assign a separate consumer compliance rating outside of the CAMEL process for such depository institutions under their jurisdiction. If you don't measure it, you can't manage to it. And we aren't giving large, complex credit unions a tool that they need to manage consumer compliance performance. The Ncua's approach to consumer financial protection reviews also runs counter to the congressionally mandated mission of the Federal Financial Institutions Examination Council, which works to develop uniform standards and processes across all financial institutions regulators. That's one of the reasons why Americans for Financial Reform Education Fund notes in its comment letter, like banks and other financial institutions, credit unions are required to comply with the consumer protections that Congress put in place to protect families from predatory practices, discriminatory lending, and unscrupulous behavior. To address these issues, I requested that a proposal to add 3 new full-time employees to the Office of Consumer Financial Protection in 2020 be included in the staff draft budget that the agency released for comment. These employees would develop a dedicated consumer compliance examination program for large, complex credit unions, which the agency would later launch. Because my request to include a proposal for comment in the staff budget was denied, I subsequently released the proposal myself and requested public comment. The proposal received a number of comments. Not surprisingly, there were comments in support of and in opposition to the enhanced consumer compliance proposal. I would reiterate that this proposal was meant to be a first step in a longer process to determine how to appropriately strengthen the Ncua's consumer compliance program. Ultimately, I am deeply disappointed that after negotiating for almost 2 weeks and seemingly reaching an agreement to add 2 staff to the Office of Consumer Financial Protection, that agreement is not reflected in the budget before us today. In operating as a board, we each bring different perspectives to the table. When we sincerely consider those different perspectives with open minds, we can reach the compromise needed to make better decisions as a group. That's what's called the wisdom of the crowd, and that's one of the reasons why Congress invested leadership in the Ncua in a board. For the good of the credit union system and its members, I intend to continue the dialogue I started in September about strengthening the Ncua's consumer compliance program. As the credit union system evolves, so must its regulator. When we revisit budgetary matters in the future, I hope I'm not disappointed again.
Thank you, Board Member Harper. Board Member McWaters.
Thank you, Mr. Chairman. Please allow me to offer a few thoughts on consumer protection at the Ncua, beginning with an analysis of the seemingly sage advice of, if it ain't broke, don't fix it. This aphorism keeps us from wasting time and resources on things that ain't broke. It also appears to fit nicely with the consumer protection examination and supervision mandate of the Ncua. After all, the agency has experienced no Wells Fargo-type frauds. Consumer complaints are also trending at manageable levels, and credit unions respond timely to the agency's consumer protection actions. So everything is okay. But is that correct? Let me reframe the question. Under the ain't broke approach, the Ncua would wait and take action after something breaks. Specifically in the consumer protection context, the agency would wait until consumers are cheated and defrauded. Does this approach make sense for a regulatory agency? That is, should the Ncua sit on its hands and wait until there is a clear and demonstrable consumer protection problem before taking action? Certainly not. In other words, the agency should not regulate reactively, but should work proactively to anticipate future problems. This approach requires adequate resources and thoughtful leadership. Let me be clear. Our consumer protection staff has done a fine job. They, however, deserve the resources to act proactively to continue to protect consumers. I have advocated for the allocation of additional resources to the agency's consumer protection staff. In doing that, I fully appreciate the differences between credit unions and banks, and that our regulatory protocols should reflect those material distinctions. We should not simply copy the examination and supervision programs of the banking agencies that are directed to the specific risk presented by the business models of both community banks and the gargantuan too big to fail financial institutions. Credit unions are not banks. Instead, we should specifically tailor and target our consumer protection, examination, and supervision activity to the actual objective risk presented by credit unions to their members, and not the unique industry-specific risk presented by banks to their customers. Credit unions are not-for-profit, member-owned cooperatives whose reason for being is to serve their members who are also consumers. Credit unions do not operate with an equity shareholder class and their "what have you done for me lately" investment philosophy. Credit unions accordingly have every economic incentive to treat their member consumers well. Consumer protection is endemic to the Ncua and credit unions, as the typical credit union's business model focuses almost entirely on extending credit and other financial services to its member consumers. Treating consumers inappropriately is not only wrong and in violation of law, it's bad for credit union business and undermines the agency's safety and soundness mandate. As such, it's imperative that we provide the agency's consumer protection staff with the resources necessary to continue to proactively safeguard credit union customers. Consistent with my first board statement in 2014, we should not hesitate to add staff that are necessary to fulfill our safety and soundness mission, provided we can justify in an objective and transparent manner their addition. We should also at all times remain mindful and respectful that the Ncua is funded with other people's money, the limited resources of the credit union community. Now, as a CPA for over 40 years, I appreciate that the board's failure to approve an updated budget for 2020 would create an administrative nightmare for the agency. The proposed 2020 budget reallocates funding among different offices and categories and increases the operating and capital budgets so as to permit the agency to continue its core mission of safety and soundness. The budget for 2020 approved last year is simply inadequate for the task at hand. Given the regrettable impasse between the other two board offices, I will vote to approve the proposed 2020 budget and maintain the operations of the agency. Let the record reflect, however, that I strongly support the allocation of additional resources so as to permit the Ncua to continue to regulate consumer protection in a sensible, proactive manner. The 120 million or so Americans who rely on credit unions and our staff who carry the burden of protecting those consumers deserve that commitment. It is entirely in principle to wait until the agency's consumer protection, examination, and supervision policies and procedures are broke before we fix them. Although reasonable minds may differ concerning certain aspects, I will continue to endeavor to find a collegial and collaborative path forward that continues to protect consumers without placing unnecessary regulatory burdens on credit unions. As Mick and Keith told us back in 1969, you can't always get what you want. But if you try, sometimes you get what you need. Thank you.
Thank you. At the prerogative of the chair, I am going to allow Matt Bellaris to address us to talk about consumer protection and the group that he oversees, just to give context for the fact that we do have a very robust program in place, and also just to really allay some of the concerns that may have existed as regarding whether or not we are looking after the consumer protection needs of our 119 million credit union members.
Thank you. Thank you. Good morning.
Good morning.
I do want to reiterate my focus and what I do in running the Office of Consumer Financial Protection is informed by nearly 28 years of background as a safety and soundness examiner that has put me on a path to oversee this, looking out for consumers who, whether it's a $5 million credit union or a $50 billion credit union, have to have some protections afforded to them. So while I come from a background that has a strong appreciation of credit unions and the credit union industry and the philosophy of credit unions, I don't look at it blindly and say, I think Mr. McWaters, you hit on it just about perfectly, that just because there's a spirit of giving and a spirit of that philanthropic nature in credit unions, there has to be some appropriate safeguards over it. So with that in mind, what we've been doing since I took over the office, and what we even started before that under the predecessor, was to, under our risk focus exam, look at where we can target our areas of focus. What are we seeing in our consumer complaints? What are we seeing in our fair lending examinations? We give our examiners broad discretion to target those areas and focus their resources. But we've also started saying there's a minimum set of standards we want you to look at every time you do an examination. Prior examples of this have been the Military Lending Act, Service Members Civil Relief Act. We've looked at things regarding HMDA changes, particularly where there's changes in regulation that we think could add to some, if not additional burdens, some certain ambiguity in how to comply with the new regulation. We focus on those. Looking at error resolution with disputes under Regulation E, adverse action notices. Those are all things we started to focus on. So what we tell our examiners is, while you have some discretion to look at what you see and what you understand as district managers, they're in the best position to understand the sort of compliance footprint of their credit unions. We say at a minimum, we want you to look at these things based on what we're seeing from fair lending exams, consumer complaints, what we hear from our consumer compliance SMEs. We do have a cadre of examiners that do receive some additional training on consumer financial protection matters. They're able to assist their district examiners, their SE groups with that information, and that does help inform where we need to shape our program down the road.
Great, thank you.
Sure.
I now would like to...
Actually, since we invited Matt to the board, I'd like to ask a few questions.
Okay, very well.
Great. Matt, out of curiosity, did your office request any additional staff in the 2020 budget?
We did. We requested one FTE specifically for expanding on our consumer financial program.
And did you get that additional staff?
Yet to be determined, but it doesn't look like it.
Okay, thank you. And Matt, has the Ncua conducted a study on its consumer compliance program at the largest of credit unions, those between $5 and $10 billion, and the need to develop and evolve the Ncua's regulatory stance and supervisory stance?
So I don't know if, I don't want to be vague. Formal study, I don't think I would call it a formal study. We did petition, we did ask a group of staff who are participating in a management development program to look at our programs, look at what we have in place, look at how credit unions are transitioning to the Consumer Financial Protection Bureau when they hit the 10 billion, and see if there's any recommendations or any things we can do to help with that kind of handshake and moving those over. Their report talks very broadly about a lot of the interactions of the group together. I mean, this was a management development program, so they talked about how they learned, what they learned, the methodology they went through, and they did come up with a series of things for consideration down the road if anybody wanted to look at this further.
And have we implemented any of those recommendations?
I don't know if we've implemented any. Well, some have been done. For example, my office issued internally a fair lending report that sort of gave a state of the region of fair lending examinations internally just to staff. I think that was something they had talked about in there, but I don't think we've categorized the inventory thing and are moving forward just to implement those things.
Have the core recommendations, namely those at the recommendations aimed at improving our oversight for consumer financial protection of credit unions of $5 billion up to $10 billion been implemented?
No.
Okay. Finally, Matt, My understanding is that at other agencies, there's a career ladder that allows consumer compliance officers to begin as journeymen, if you will, and to work all the way up to the executive level.
Yes.
Here at the NCUA, am I correct in noting that the subject matter experts more or less top off at CU 13?
That is correct in the field. My staff, we do have grade 14s in my program, but from a field perspective, a principal examiner going through the consumer compliance SME designation, it does cap out of that.
So what type of signals does that send to our staff as to where they should specialize and focus their careers?
If I was looking at that path, I would question if I had a long-term footprint on that.
Okay, thank you.
Great, thank you.
Thank you, Mr. Chair. You know, I wrote in my remarks, the ain't broke, don't fix it, because I mean that's a trap we can fall into. Hey, everything's okay right now. Everything was really great about 3 minutes before the Titanic hit that big piece of ice. Okay, and we don't want that to happen. So we need resources in order for you to be able to act proactively and not react to risks that may be presented in the future. I mean, in 2005, 2006, the economy was booming. We were on the precipice of doing a Thelma and Louise in 2008, but no one was paying attention. I need guys like you out there paying attention, but I need you to have the resources to do it. But we need to do it in a way that's tailored and targeted to the risk presented by credit unions. Credit unions are not banks. You know, JP Morgan Chase with their international portfolio and the deals they do and the risks that are created are entirely different from a credit union model, which is owned by members, owned by consumers. I mean, credit unions have the least incentive imaginable to do something that would be inappropriate to their members because they're all consumers. So we need to be mindful of that and weigh that. There's not a one-size-fits-all approach to consumer protection. I think there's something to be learned from the FDIC, the OCC, and the Fed, but I don't accept their model as necessarily a template. Thank you.
Great, thank you. Now, are we ready for a motion?
Yes, sir. I move that the board approve NCUA's 2020 operating fund budget of $315,883,000 and 1,180 FTEs, and the 2021 operating fund budget of $327,973,000 and 1,180 FTEs, and that $2 million from unspent prior year balances, of which $1,750,000 will be reallocated from past year's capital budgets, is available for expenditure from the operating fund in 2020. Number two, the 2020 capital budget of $25,076,000 and the 2021 capital budget of $25,205,000. And three, the 2020 share insurance fund administrative budget of $6,450,000 and 5 FTEs in the 2021 share insurance fund administrative budget of $6,932,000 and 5 FTEs, all as detailed in the board action memorandum.
Is there a second to the motion? Hearing none, I second the motion. All in favor say aye.
Aye.
All opposed say nay.
Okay.
The ayes have it, and let the record show the motion passed 2-1. Thank you, gentlemen. The second item on our agenda today is Final Rule Part 702, Risk-Based Capital. Staff presenting Larry Fazio, Director, Office of Examination and Insurance, Julie Casey, Director, Risk Management Division, and Ian Marina, Associate General Counsel, and Rachel Ackman, Senior Staff Attorney, Office of General Counsel. Welcome, all of you.
Thank you, and good morning, Chairman Hood, Board Member McWaters, and Board Member Harper. Associate General Counsel Ian Marina, Senior Staff Attorney Rachel Ackman, and Director of Risk Management Julie Casey and I are all here to request the board approve the final rule to change the effective date of the October 2015 final risk-based capital rule, to change that effective date from January 1st, 2020 to January 1st, 2022. I'm now going to turn it over to Julie to discuss the background of this rule.
Thank you, Larry. Under the final rule approved in October of 2015, risk-based capital was originally scheduled to go into effect on January 1st, 2019. However, in October of 2018, the Ncua board approved a supplemental rule making two fundamental changes to risk-based capital. These changes included increasing the asset threshold, defining complex credit unions from $100 million or more in total assets to $500 million or more in total assets, and changing the effective date from January 1st of 2019 to January 1st of 2020. In June of 2019, the Ncua board approved a proposal to change the effective date of the risk-based capital rule to January 1st, 2022, with the 30-day comment period. Overall, the Ncua received 29 comments in response to the proposal. Most of the commenters, 25 out of the 29, were in favor of the change of the effective date. The commenters in support of the change were credit unions, credit union and state regulator trade associations, state and regional credit union leagues, and one individual. The majority of the commenters support the board taking an additional time to conduct a holistic review of the risk-based capital rule. The change in the effective date will provide sufficient time for the Ncua to develop and implement improvement to the Ncua capital standards subject to board approval. Specifically, staff is working on a proposed rules to authorize subordinated debt, allow complex credit unions the option to use a simplified standard to comply with risk-based capital, like the community bank leverage ratio alternative recently provided by the banking agencies, providing a 3-year phase-in for the impact on capital ratios from the Financial Accounting Standards Board Credit Expected Credit Loss Standard, or CECL, and improved capital and other prudential requirements for credit unions securitizing their assets. I'm now going to turn it back to Larry for concluding remarks.
Thank you. So the Ncua can't afford to take additional time to make these improvements and have all of the capital standards go into effect in a coordinated and integrated manner. The level of net worth in the Crane system is high at 11.4%. In fact, over 99% of complex credit unions would be considered well capitalized under risk-based capital. The share insurance fund is healthy. The level of problem cranes is very low, and the economy is strong. In addition, during this additional period, if the board approves this delay, the Ncua's current risk-based net worth requirements will remain in effect, and the agency will continue to use existing requirements and authorities to ensure credit unions operate safely and soundly. For all of these reasons, the incremental risk to the insurance fund posed by a 2-year extension of the effective date is manageable to ensure we implement the rule in an integrated way. This approach is also more efficient and less disruptive to both credit unions and the Ncua. At this point, we'd be happy to answer any questions you have.
Great. Thank you, Larry. Thank you all for your hard work. As you know, when I became chairman last April, I identified several key regulatory and supervisory priorities. One of those priorities is to take a meaningful look at how the Ncra measures and evaluates credit unions' capital adequacy. As capital, as we all know, plays a vital role in the safety and soundness of credit unions and the protection of the National Credit Union Share Insurance Fund. Federal Credit Union Act requires the Ncra to maintain a system of prompt corrective action for federally insured credit unions that is based on an institution's level of capital or net worth. The Act also requires the Ncra to maintain a risk-based net worth requirement for those institutions we deem to be complex credit unions. Sound capital levels support our core mission to maintain a safe and sound credit union system and also serve as good stewards of the Share Insurance Fund. Today, the credit union industry is healthy and very well capitalized, as you, Larry, noted in your comments, at 11.4%, significantly above the statutory requirement of 7%. The rule had been slated to take effect on January 1st, 2020. Based upon feedback we've received from industry stakeholders, we determined that an additional 2-year delay in the rule's implementation would be beneficial for credit unions and their members. with little additional risk for the safety and soundness of the system. Additionally, based on the 2018 data, if the NCUA's risk-based capital rule were to go into effect today, just 545 complex credit unions would be subject to its requirements, and more than 99% of all complex credit unions would be considered well capitalized, as you in fact noted in your remarks. I believe that the current capitalization of the credit union industry provides time for the board to consider modifications to the rule. I want to adopt the right capital framework, and I want us to do it right, as I also mentioned in last week's congressional testimony. Any potential revisions to our capital standards would reflect my belief that having a strong capital framework is an integral part of the NCUA's supervision of credit unions. I believe that there is little reason to move faster simply for the sake of moving faster. Poorly considered regulatory action can be as great or greater a risk than inaction, and our goal should always be to ensure that the actions we take are well considered and prudent. As a regulator and steward of the National Credit Union Share Insurance Fund, I'm committed to a system of prudent capital standards as required by the Federal Credit Union Act. I look forward to continuing to review the RBC rule more closely in the months to come and making additional improvements to the rule that will serve to make it more effective for credit unions and the nearly 1/3 of Americans they serve. I now have a few questions. The Federal Credit Union Act, in part, requires the NCUA to establish a prompt corrective action system, or PCA as we call it, that is comparable to the statutory PCA system for insured banks, and include a risk-based net worth requirement for complex credit unions. Are credit unions today currently subject to the risk-based net worth requirement?
Yes, the credit unions that meet the current definition of complex, which is a multi-part test, starting with the fact that the credit needs to have more than 50 million in total assets, and then there's the calculation they have to go through to also determine whether they're subject to it. But yes, that is in effect and will remain in effect during this extended period.
And again, I would note that while we have the PCA program or the system, it is comparable to the other bank regulators, but not identical.
Correct.
Some commenters question whether we meet our statutory obligation. Do we meet the statutory standard for a PCA framework that really does work or for other insured institutions?
I'd be happy to address that. So the NCUA currently has a PCA framework that is comparable to that of the other regulators, consistent with the statutory requirement.
So we are meeting that requirement.
Correct.
Would the 2015 final rule require most credit unions to increase their capital levels?
No, in fact, there would only be a net of 4 credit unions that would be deficient as a result of the new risk-based capital system. So most credit unions would not have to increase their capital levels other than those 4.
And those 4, could you explain the steps that we as an agency would take to get them within our statutory requirement?
So of those 4, they would all be considered adequately capitalized under the rules. And when a credit union is adequately capitalized, they're only subject under the rules and under the law to an earnings retention requirement. So they just need to operate profitably. It's equivalent to about 40 basis points of ROA, return on assets, or net income for the year. They are not yet subject to a net worth restoration plan. They would have to fall to undercapitalized to be subject to a net worth restoration plan and potentially other discretionary supervisory actions. So those 4 credits would be adequately capitalized.
Very well, thank you. I do have one final question. Are the current capital levels in the industry and the current rule in effect sufficient to protect taxpayers and the National Credit Union Share Insurance Fund from losses from current and reasonably foreseeable risk?
Yes, as we've noted, the credit system is very well capitalized, and in addition to that, the insurance fund is very healthy right now, and so the industry and the Share Insurance Fund are very well positioned to deal with any potential risks that come in the near future.
Great, thank you. And in fact, the Insurance Share Fund is resting today at $16.7 billion and well above the $10 billion it was coming out of the recession. So thank you. I have no further questions. Board Member Harper.
Thank you, Ian, Larry, Julie, and Rachel. And Julia, this will be your last time in your current role at the board table. You're going off to be one of our associate regional directors in Tempe, and I congratulate you on that promotion. It's well deserved, very much so. Before I go to my statement, the chairman's questioning actually prompted me to think about a number of questions, and I believe both Larry and Ian, you said that our risk-based capital, actually risk-based net worth standard is comparable, was the word used to the others, our other financial regulators. Did I get that correct?
Correct.
Did those other regulators act after the financial crisis to modify their risk-based capital rules?
That's my understanding. Larry may have more familiarity.
Have they, Larry, is that your understanding as well? Did other regulators, other financial regulators work to update their risk-based capital rules?
Yes, I do want to be clear. The chairman asked whether or not the PCA framework was comparable, and that's actually, as I understand it, the statutory criteria, and the answer is the whole framework is comparable. Our risk-based requirement, they did modify it. I think they did an interim final rule in 2013, and then fully finalized it in 2014, and that was a modification off of their standards. Our framework is our risk-based net worth requirement does vary somewhat from that, but it does have a comparability aspect to it in that it does require a risk-based calculation, and it does drive capital levels, at least for those credits that are subject to it. And so in the totality, my understanding is our general counsel still believes it meets the comparability standard.
Did those other regulators implement their revisions to risk-based capital since the financial crisis? Are those implemented?
I'm sorry?
Have the other financial institutions regulators implemented their risk-based capital rules post-crises?
Yes.
Okay. Has the Ncua modified its rules post-crises?
So I believe we did a minor modification in 2013 to the rules.
I'm really talking about the rule that we're delaying here today.
The risk-based capital?
Yeah, did we modify our rules?
Well,
generally, yes. We adopted a modified risk-based capital set based on what other regulators had done so that we could maintain the statutory comparability.
Yes, we finalized the rule, but it has not gone into effect.
And that's exactly what my next question was. Have we implemented that?
We have not.
Okay, thank you. It's often said that those who forget the past are condemned to repeat it. In terms of the current efforts to further delay the risk-based capital rule, the National Credit Union Administration Board is forgetting the past, just like the characters in Groundhog Day. In my view, the time has long since come for the Ncua to implement this tailored common sense standard. In June, the Ncua proposed to further delay its risk-based capital rule. I voted against proposing that delay because all financial institutions backed by federal deposit insurance, including credit unions, should hold capital equal to the risks held on their balance sheets. In the case of federally insured credit unions, if a credit union with greater risk fails, risk-based capital would help to minimize losses to the share insurance fund. That additional money would protect surviving credit unions, their members, and taxpayers. Putting risk-based capital safeguards in place before the next recession is sound public policy. We don't know that a recession is coming, but we do know that a recession is coming at some point. We just don't know when and how severe it will be. That's why we should fix the roof before it rains by implementing this rule at the start of 2020. With respect to safety and soundness, the Ncua's supervisory efforts should focus on the institutions and activities posing the greatest risk to the share insurance fund, like concentration risk. The recent losses at several federally insured credit unions that concentrated heavily in taxi medallion lending highlight why we need to swiftly implement, not further delay, the safety and soundness regulation. These failed credit unions held significant concentrations of taxi medallion loans on their books, as much as 97% of all loans. According to the Ncua Inspector General's recent material loss review, just 3 of these failures resulted in an estimated loss of $765.5 million. That's money that surviving credit unions ultimately could have used to increase consumer lending, lower interest on loans, or increase dividends paid to members. After the Great Recession, the FDIC and other banking regulators moved promptly to update and implement their risk-based capital standards. Yet the NCUA wants to delay implementation for a second time. Why should it take complex, federally insured credit unions with $500 million more in assets 7 or 8 years longer to implement their comparable risk-based capital rule than it took for banks and thrifts to implement theirs? That's an uneven regulatory field. Let's also compare the coverage of the risk-based capital rules for banks to the standards that could be in place for federally insured credit unions at the start of 2020. Approximately 9 out of 10 credit unions would be exempt from the NCUA's current risk-based capital standards. In contrast, not a single bank is exempt from the FDIC's risk-based capital rule. Since 2014, 100% of all banks have had to comply with those rules. Capital is the last line of defense that protects the share insurance fund from losses. Capital also protects U.S. taxpayers from having to shore up the share insurance fund, as they did during the Great Recession, when the NCUA had to ask Congress for a temporary multi-billion-dollar line of credit from the U.S. Treasury. Without that line of credit, the share insurance fund would have gone into the red by 9 basis points, threatening the viability of hundreds of others credit unions. Pursuant to the Basel Accords, which set international best practices, no modern financial institution's regulatory system operates without a meaningful risk-based capital component. Not only would the 2015 risk-based capital rule finally bring the NCUA into greater compliance with the Basel framework, it's required by the Credit Union Membership Access Act. That's why the risk-based capital standard is consistent with the cooperative nature of the credit union system and provides comparability to other federal banking regulators. Because the NCUA's existing risk-based net worth requirement is ineffective, it's time for the NCUA to move ahead with its risk-based capital standard. The current risk-based net worth rule is binding only on a single credit union, but the soon-to-be further delayed rule would apply to approximately 574 credit unions with an estimated $1.2 trillion in assets. That's nearly 80% of the assets of the credit union system. As any of these complex credit unions carries out riskier activities, they would be required to hold additional capital equal to that risk. That money will protect the share insurance fund before there is a problem, rather than leading to premium assessments after the fact. Moreover, the additional capital will come from a small number of credit unions with relatively risky balance sheets, not from the vast majority of credit unions with less risky balance sheets that might ultimately pay the price if a second delay is adopted. In sum, further delay of this much-needed safety and soundness standard would make the NCUA a day late in meeting the recommendations of the GAO and the Inspector General, and the Share Insurance Fund a dollar short when it comes to yet another credit union liquidation because it failed to hold capital commensurate with its risk. After a decade of work on the new risk-based capital framework, the Great Recession, and the tax medallion credit union failures, it is therefore time for us to move ahead to protect taxpayers, federally insured credit unions, and their members before it's too late. Accordingly, I will vote no on this rule.
Thank you, Board Member Harper. Board Member McWaters.
Thank you, Mr. Chairman. I don't think I'm forgetting the past. But I am remembering that I voted against the proposal of this rule and the finalization of the rule because based on over 3 decades of legal experience, in my opinion, and I put this in writing, it's on the website as to why this rule violates the Federal Credit Union Act. That's what I believe as a lawyer, as a member of the Bar of New York and Texas, and it would have a difficult time in good faith not stopping this rule from becoming effective. I laid out, and I will not go over it again exactly why I feel that way, but it was fairly rigorous, objective, transparent legal analysis that at one time the NCUA subscribed to until the NCUA suddenly and shockingly changed its position on the legality of this rule. So I'm not going to vote to have a rule go into effect that, in my opinion, as a lawyer for over 3 decades, violates the law. Number 2, we're looking now a little more proactively at a suite of capital rules for credit unions. Those capital rules include subordinated debt for non-low-income credit unions, the subordinated debt that can count as capital for risk-based net worth purposes. Currently, that does not exist. And in my view, under the theory that more capital is better than less capital, the subordinated debt rule, it's been drafted, and it's my understanding I've received distinct assurances it will be brought before the board in January. It's a good rule. It's a complex rule. We'll need a lot of feedback on it. The other rule is a spinoff from the community bank leverage ratio. It's what we would call presumably a credit union leverage ratio. That rule is entirely different. What it says, if you're a credit union under $10 billion, and if you meet this rule, you do not have to comply with the risk-based net worth rule. It's the same as the community banks have. If the community bank meets their community bank leverage ratio rule, the community banks will not have to comply with the risk-based net worth rule for the banks. I've received assurances that this rule will be brought before the board in February. So having this suite of capital rules, actually giving people who run credit unions options here. I think options are important. Credit unions may not accept those options. They may not follow them. They may not want to. It's entirely a business decision. But the ability to use sub-debt and the ability to comply with a credit union leverage ratio is appropriate thing to do. So I'll leave it at that. I have no questions.
Thank you. And I would just add, in delaying the rule, I mentioned this the first time, it was that we're looking at now capital adequacy holistically. And to the facts and points that Board Member McWaters made, we're looking at holistic approaches such as subordinated debt and a credit union leverage ratio, just to name a few of the types of things that are under consideration. So again, we're sitting at a wonderfully strong position now of 11.4% in aggregate net worth, a very robust and healthy National Credit Union Share Insurance Fund. So it's all of those factors that give me solace as we then take this additional delay, but recognize that there will be additional tools coming before this board in the months ahead. With that being said, is there a motion?
Yes, Mr. Chair. I move that the board approve final rule part 702 of NCUA's rules and regulations as attached to the board action memorandum.
Is there a second to the motion? Hear none, I second the motion. All in favor say aye. Aye.
Aye.
All opposed say nay.
Nay.
The ayes have it, and let the record show the motion passed 2-1. Thank you all. The third and last item on our agenda today is a board briefing on the 2020 Share Insurance Fund normal operating level. Staff presenting, Larry Fazio, Director, Office of Examination and Insurance, Julie Case, glad you're still with us, Director of Risk Management, and Andrew Leventis, Chief Economist.
Thank you, and good morning again.
Is it still morning? Yes.
Yep, I think we're good. Well, we're here today to brief the NCUA board regarding the results of the normal operating level calculation for 2020. So based on the board-approved methodology, the normal operating level calculates as 1.38%. We will provide additional details in a few moments about the calculation for this year. However, before we do that, we'd like to discuss the statutory criteria for the normal operating level and the objectives of the board's policy for setting the normal operating level. Then we'll conclude with a summary of next steps. So as you know, the Federal Credit Act requires the NCUA board to set what is called the normal operating level for the Share Insurance Fund. The normal operating level represents the target equity ratio for the fund and is the point at which excess equity is returned to credit unions. The Act requires the board to set the normal operating level from 1.20% to 1.50%. That's the range. I'd also like to emphasize a few of the other statutory criteria. First, if the equity ratio falls below the minimum of 1.20% for the normal operating level, the Act mandates that the board must assess a premium to restore the fund to at least 1.2% or adopt a restoration plan. Another point I'd like to emphasize. The Ncua board may not assess a premium if the equity ratio exceeds 1.30% under the law. Therefore, even though the equity ratio could go as high as 1.50%, the maximum that the board's allowed to set the normal operating level at, it can only really grow above 1.30% through investment and other earnings, but not through premiums. So regarding distributions, the calendar year-end equity ratio of the fund is one of the primary bases for determining whether a distribution to credit unions is required under the Act. Specifically, if the year-end equity ratio exceeds the normal operating level, any loans associated and associated interest to the fund from the federal government have been repaid, or there's none outstanding, said another way, and the fund's available asset ratio exceeds 1%, then the Ncua must return the excess amount to credit unions in various forms, typically a distribution. And then finally, by way of reminder, the normal operating level was set for this year, last year, was set for 2019, based on the methodology adopted by the board, and it was set at 1.38%. So the amount calculated for next year is the same 1.38% as it is for this year. However, the details vary a little bit, and we'll cover those in a second. In terms of the objectives here on this slide, when the board approved the policy for setting the normal operating level, the new policy that was adopted in 2017, it had three stated objectives. The first objective was to retain public confidence in federal share insurance. It's important that consumers and the public feel that we have a strong and healthy fund that promotes confidence in both credit unions and in the insurance that they have for their accounts. This is really largely achieved through the other two objectives, as well as us having a strong exam program. The second objective is to prevent impairment of the 1% contributed capital deposits. As you know, credit unions maintain 1% of their insured shares. They maintain that deposit in the share insurance fund, and that's reflected as an asset on their financial statements. So by preventing impairment of the 1% deposit, the Ncua avoids exposing credit unions to losses they would incur under accounting rules if they had to write down their 1% deposit. And then finally, the third objective seeks to ensure the insurance fund can withstand a moderate recession without the equity ratio declining below 1.2% over a 5-year period. And by way of reminder, that 1.2% is the level at which the board would either be required to charge a premium or to develop a fund restoration plan. So the goal is to be able to avoid a premium during an economic downturn and the recovery, which is when credit unions could least afford it. Also, relying on a fund restoration plan during an economic downturn could erode public confidence in credit unions and the share insurance that they have. And it wouldn't also necessarily eliminate the need to do a premium as well during the period. So managing the fund to withstand a moderate recession covers a relatively broad range of outcomes. But there are a number of economic scenarios that could have a greater impact on the fund, but do not rise to the level of a severe global recession. So managing to the moderate recession scenario does ensure the insurance fund is prudently managed, that it is countercyclical, and that it avoids premiums and impairment of the 1% contributed capital deposit at times when credit unions can least afford it. This benefits both credit unions, their members, and taxpayers. So it's important also to note that our analysis for the normal operating level for 2020 uses June 30th, 2019 data to generate a point-in-time estimate based on the best available information at that time. Economic conditions that involve greater volatility in one or more market indicators as compared to the stress scenario model can also lead to different outcomes. So using the economic scenarios developed by the Federal Reserve as part of their work on the comprehensive capital analysis and review, we model the impact of our moderate recession on the equity ratio over a 5-year period. For the share insurance fund's core exposure, we look at three primary drivers. First, to the equity ratio. First, insurance losses, so credit union failures that would occur and the losses associated with that. That obviously affects the numerator of the ratio, of the equity ratio. Second, we look at insured share growth. What we tend to see, of course, in a recession is what we call a flight to quality. Consumers typically increase their deposits in federally insured institutions. So you tend to see elevated share growth. That raises the denominator of the equity ratio calculation. And then finally, we typically see a change in the interest rate environment in a recession. Usually the Fed is lowering rates to try to help stimulate the economy. And our reinvestment rate opportunity for the insurance fund's investment portfolio typically goes down. And so we model the impact on the earnings of the fund through investment income, and that affects the numerator. And so we put all of that into the model, and Andy's actually going to go through the results for this year here in a moment about that. But that's our core exposure going forward. We also have to think about another exposure we have, and it's a temporary one. And so we, through this methodology, we model the share insurance fund's exposure to a loss on the corporate asset management estate claims. And we also model that through a moderate recession as well, same factors. And that makes sure that we can handle those losses that would occur through the corporate legacy assets and the NGN program, and then affect the claim on the financial statements of the share insurance fund, vis-a-vis reducing it and causing a loss to the fund. And then the final factor that we'll go through is we also, in order to protect that amount of equity we're holding to get through the NGN program if we had a moderate recession, we also have to project forward during that time period. And by way of reminder, the NGNs will have matured by June of 2021. So that's the time horizon we're talking about. So we model the expected decline, if there's an expected decline in the insurance fund's equity ratio between now and the end of 2020, so we can account for that as well. And that's the third factor that we look at. And that ensures that we preserve that additional equity needed until the corporate credit legacy assets can be sold and the associated risk to the insurance fund's equity ratio removed. So at this point, I'm going to turn it over to Andy to discuss the calculation for the normal operating level for 2020.
Thank you, Larry. As you can see on this slide, the results of this year's calculation indicate a normal operating level of 1.38 for 2020. This is the same level as last year. Therefore, no board vote is required to set the normal operating level. I would note, however, that individual factors in the calculation have changed a little. In particular, the fund's core exposure has gone up by 2 basis points, from 13 basis points to 15 basis points. This was offset by a decrease of 2 basis points in the projected equity ratio decline through December 2020. The estimated reduction in the value of the claims on the corporate estates remained the same at 2 basis points. By way of reminder, the normal operating level has no effect on the claims against the corporate credit union asset management estates of depleted member capital investors. The recovery for depleted capital holders operates on a different basis than any return of assessments. The increase in the exposure from 13 basis points to 15 basis points does not reflect a fundamental change in the risk profile of the credit union system. It generally reflects small changes in the severity of the stress scenario and various technical factors. In terms of the stress scenario, we once again use the adverse scenario published by the Federal Reserve for its stress testing. This year, the Fed scenario assumed a slightly more severe house price decline than it did last year. For example, last year's stress path assumed a roughly 12% decline in home prices, while this year's decrease was about 14%. Beyond that, the increased exposure can also be partially attributed to an increase in the 5-year historical average of insurance losses. We use this average to calibrate our model of stress losses, and thus the increase in historical losses elevates assumed losses during the stress event. Finally, an additional driver of the increase in measured exposure is simply lower reinvestment rates. Under the maturity structure of today's share insurance fund assets, a larger volume of bond holdings would mature during the most severe part of the stress scenario. This means that yields on fund reinvestments during the stress period are lower this year than they were last year. In addition to analyzing the impact of a moderate recession on the equity ratio, we also modeled the impact of a severe recession. As this slide illustrates, a severe recession would reduce the equity ratio by an additional 6 basis points over the moderate recession scenario. That is, in a severe recession, the normal operating level would need to be 1.44% to ensure that the equity ratio wouldn't fall below 1.2%. I would note that this slide tells us that under the recommended normal operating level of 1.38% and a severe recession, the equity ratio would be expected to fall to 1.14%. This means that despite the more severe economic conditions, there still would be no impairment of the 1% contributed capital deposit. Thus, setting the normal operating level of 1.38% meets the 2 policy objectives set by the board. 1, preventing impairment of the 1% contributed capital deposit, and 2, ensuring the equity ratio does not fall below 1.2% in a moderate recession. I'll now turn it over to Julie to discuss variances in the actual results and next steps.
Thank you, Andy. It's important to keep in mind that these are projections. Actual results may vary based on things like extraordinary losses and/or failures in credit unions, abnormally high share insurance growth, or volatile economic conditions. As discussed, there is no change to the normal operating level of 1.38%. The December 31st, 2019 equity ratio is important because it is the part of the statutory basis for determining whether a distribution is made to insured credit unions. There are several pieces of information necessary for calculating the equity ratio. This includes the results of the share insurance fund's operations, which will be available in mid-February 2020, when the share insurance fund's audited financial statement becomes available. Based on year-end call report data, the Ncua will validate insured shares data by the beginning of March 2020. Once calculated, the equity ratio is compared to the normal operating level. Should the equity ratio fall below the normal operating level, no distribution will be made and no premium may be charged unless the equity ratio falls below 1.30%. When the equity ratio exceeds the normal operating level and all other regulatory requirements are met, the share insurance fund must pay a distribution. Any distribution will come down to the extent to which the equity ratio exceeds the normal operating level at calendar year end. Current projections indicate the year-end equity ratio will be approximately 1.37%. Thus, we are not expecting a 2020 distribution at this time. We would now be happy to answer any questions you may have.
Great, thank you. And thank you all for your hard work in helping us in calculating the normal operating level. A healthy share insurance fund is fundamental to maintaining a safe and sound national credit union system. It benefits members, credit unions, and taxpayers. The Ncaa board approved methodology for setting the normal operating level. The Ncaa's approach seeks to ensure the share insurance fund can withstand a moderate recession without needing to assess premiums. This is a prudent approach given the current and reasonably foreseeable risk to the share insurance fund. Maintaining sufficient equity to respond to market risk is fully consistent with the responsibilities of the Ncaa board under the Federal Credit Union Act. To do otherwise would be irresponsible and feckless. In setting the normal operating level, the Ncra board must consider not just past performance, but also how the credit union system is evolving in today's dynamic marketplace. I now have a few questions. Can one of you please discuss how the increase in core exposure is primarily related to technical factors in the assumptions as opposed to significant changes in the risk profile of credit unions?
Yeah, so I think it's very fair to say that the increase in the quote-unquote exposure from 13 to 15 basis points is a function of technical factors and assumptions. In effect, as I indicated, the adverse scenario became slightly more severe this year, thanks to the Fed's adjustment. And also there's the lowering of the reinvestment rate, and then also the calibration basis of our future estimates is based on the 5-year look back of insurance losses. So all three of those factors sort of conspired to make it, well, to increase the quote unquote exposure from 13 to 15 basis points. But I would characterize that as a technical adjustments based on effectively assumptions.
Very well, thank you. And Larry, you mentioned also in your remarks the methodology when the NCUA guaranteed notes are going to mature and the underlying legacy assets are disposed of. Can you just elaborate what's going to really happen?
Sure. If we could go back a few slides to the one that lists the, and I be back another slide or two. Yeah, that'll work. So in the method, we start obviously with the statutory minimum of 1.2%. That's the floor we're trying to manage to avoid going below in a moderate recession. The next line there, the first plus line, is the core, what I'll call the core exposure. Andy just talked about that. That would obviously remain. That's a ongoing sort of permanent exposure we have that we'd be looking at every year. It's the last two pluses, the potential decline in the claims on corporate estates, and then the amount of equity decline we're expecting prior to when we reach the point where we can shed that exposure. Those two items would be the ones that would drop off once we get to the end of the NGN program sometime in 2021, and we also sell the underlying legacy assets, which might take towards the end of 2021 to do. And so let's call it the end of 2021 for right now. Then those two the second and the third pluses would drop off. We'd also at that point be reaching the time period where this methodology would have been in place for 3 or 4 years. And my recollection is that we committed to putting this method out for comment periodically. We would be retooling it, obviously, to make those adjustments because that exposure would go away. So we would develop a proposal, and board willing, of course, seek public comment on that, and then solidify the new method going forward. Expecting it to largely mirror this, but haven't made those adjustments.
Great, got it. And I do have one final question. It's the number one question I get as I travel and meet with credit union stakeholders. I've yet to go to a credit union roundtable convening conference or anything of that sort without the question coming up, with the normal operating level now of 1.38%, will there be distributions in 2020?
There will not be distributions anticipated for 2020. However, we do need to wait for year-end data to confirm that.
Great, thank you. I have no further questions. Board Member Harper.
And I also received that question, maybe not at every. But at nearly every, somebody seems to want to know when they are going to get their distribution. Larry, Julie, Andy, thank you so much for your informative briefing on the Share Insurance Fund's normal operating level and for underscoring the importance of a strong fund. Saving during good economic times helps the NCUA and credit unions to navigate bad economic times. But we should also be asking ourselves how to improve the management of the Share Insurance Fund. Accordingly, I have a few questions for you. As I understand it, the NCUA board, and in fact, Larry, you spoke about this, the NCUA board cannot assess premiums if the Share Insurance Fund level exceeds 1.3%. That statutory limit prevents the fund from collecting reserves in good times to pay for losses in bad times. Would you explain why a countercyclical premium, if it were adopted into law, would be beneficial for the credit union system?
Sure, and I think the way to think about that is you try to avoid what's called a pro-cyclical position, where the economy turns down, unemployment goes up, asset values go down, credit unions come under increasing stress on their earnings and capital and liquidity, right through loan defaults and other maybe investment performance, what have you, right? So they're under earnings pressure, capital pressure, liquidity pressure during that period. And if our fund isn't strong enough to sort of ride that out, to spend down the reserves we've built up, then we're in a position where we need to be charging a premium during that period when they can least afford it. That adds to the cycle. It's pro-cyclical. It adds to the pressures. The counter-cyclical position is the opposite. You've built up the fund in good times when they can afford to be paying in to the fund to let it draw down during a hard economic time for the industry. And so you don't have to charge them premiums, or you don't have to increase the level you're charging them during that period when they're already under stress from these other economic scenarios.
Great. Thank you, Larry. Next one, it's sort of a multi-part question, and if you'll let me. Does the Ncua have enough legal flexibility to manage the share insurance fund, or would broader authority be beneficial? For example, for banks and thrifts, the FDIC may charge risk-based premiums. We have to do pro rata premiums and they can also use total assets, where we have to just use total shares of an institution. Would it make sense for the Ncua to have similar legal powers to be able to charge risk-based premiums and to look at total assets as opposed to total shares?
So I'll start with answering or stating the following, that the fund is very well positioned currently, but based on discussions we've had on other board items today, it's also good to look forward. And it may not always be the case that the fund is positioned where it needs to be, and that the board would have the flexibility it needs to manage it that way. And so I think in my mind as a risk manager, the biggest impediment to managing the fund that the board has now, based on the current statutory construct, is the limit on premiums above the 1.30% level. So if the equity ratio is above that, you can't charge a premium to build the fund up in good times if you thought you needed to. Now, right now, we don't think we need to. Our fund is very strong, and it's at right about where we think it needs to be. But if that were not the case in the future, the fundamental risk factors have changed, the environment has changed, and we thought it needed to be higher, and we weren't at that level. The only other way to get there, as I noted previously, is through earnings. And given the low rate environment, it's in relatively strong insured share growth and claims, a reflection of their success. The fund can't keep up with the growth in insured shares through earnings on the investment portfolio right now. And so there's no practical way to build the fund if you thought you needed to beyond the 1.30%. And so the biggest, I think, limit on the board's flexibility in managing the fund as we look forward would be the limit on premiums above 1.30%. I mean, if you think about it, the statutory floor is 1.20%. Really can't manage above 1.30%. That's a pretty narrow range to manage within. Of course, that's a matter for Congress to decide. The second limit overall is the 1.50% cap on the fund, really the normal operating level, which is an effective cap on the size of the fund. There could be a time in the future where a board, looking at the risk profile and so forth, thought that the fund would need to be bigger than that. And of course, under the current statutory construct, they would not have that flexibility. The final two items that you mentioned, risk-based premiums and using total assets as the basis as opposed to pro rata via insured shares. Again, also a matter for Congress to decide. As a risk manager, I think there is some utility in risk-based premiums, and there's some utility in having the flexibility to do total assets versus insured shares, but probably not as important from a managing the risk standpoint as the first two that I mentioned.
Thank you, Larry. I have no further questions.
Oh, great. Thank you. Board Member McWaters.
Thank you, Mr. Chairman. To me, it's always interesting to note that credit union community is approaching $1.5 trillion of assets, and we have a share insurance fund of around, let's say, $16.5–17 billion. This is razor thin here. There's not a lot of leeway here, whether or not there's a normal operating level set at 1.38, or if we had statutory approval and went to 2.0, it's still razor thin, which tells me that what's really important is our supervision and examination that we're doing here. This is the fallback. This is if something is really broken. that we're looking here. On page 5, I believe, yeah, page 5, normal operating level. This is getting to the chairs and board member Harper's comment about people in the community asking about distributions. So if we look at 2020, the potential second line, potential decline in insurance fund performance popped up a couple of basis points. So if we go to 2021, let's say, and in 2021, don't all the NGNs come due?
Yes.
Okay, so that third line, the 2 basis points would presumably go away because that risk would be gone. And in the fourth line, the 1 basis point, by then that should have burned off also. So it's possible under that snapshot in 2021, someone may say, well, you have 1.20 plus 0.15, that's 1.35. So you could set the normal operating level at 1.35. And if you have an equity ratio of 1.38, that'd be a 3 basis point dividend at that point in time. But I think what's important to consider, and maybe Andy is better to comment on this than anyone, is that line number 2, potential decline in insurance fund performance at 0.15%. That's not set in stone. We don't know what that's going to be in 2021, and it's possible that could go up and offset the decline in the third and fourth items. That's
absolutely fair to say. And, the Fed does its best to establish an adverse scenario and a severely adverse scenario, but their scenarios bounce around a little bit. So, it's important for us to monitor that. There's always some possibilities of going a little bit further, and instead of using just exactly their scenario, using let's say a weighted average of the last couple years scenarios. Larry and I have spoken about that a little bit, but the point is that that number, is the best guess of some economists at the Fed, and they do their best, but certainly there are more severe outcomes that are possible, and indeed they're severely adverse, which is used probably by a larger share of the regulated entities throughout the U.S. At least my understanding is for stress testing. That's what they put out there for a more severe path than what we follow. So
okay. So in computing that 0.15, we have looked at Federal Reserve Board of Governor methodology and applied it to our share insurance fund.
Yes, we use their scenario, which includes all sorts of macroeconomic statistics about what would happen in a moderate recession. It provides unemployment rate estimates. I think our adverse scenario, the adverse scenario that they provide, has unemployment rising to about 7%.
Okay.
And then of course, importantly, it also includes house price decline stresses and then interest rate estimates.
Okay.
But it's all provided by them in spreadsheets and so forth.
Okay, so it's an objective standard.
Yes.
Last time I checked, you have a PhD in economics from Princeton.
Last time I checked.
I suspect you learned a heck of a lot during that. So you take what the Fed has, put it through the credit union matrix, and come up with that.
That's right.
So the only other point I would make is on slide 6. It's a severely adverse scenario. I mean, it's easy to not pay as close of attention as perhaps we should, but I would think that what happened in 2008, September 2008 into 2009, the Great Recession, was something that would that meet the severely adverse standards?
By some measure, yes. I mean, obviously, all recessions are a little bit different, but if you just look at the unemployment rate assumed and they're severely adverse, I think they have it peaking out at about 10%, and that's roughly in line with what we saw during the Great Recession.
Okay. So in order to be a bit conservative. We don't necessarily need to mark to that, I think, in setting the normal operating level, but we should remain mindful of it.
Seems
Okay.
fair.
Thank you.
Any additional questions? Good discussion. I do just have one for the record, Larry. You did mention this in your remarks. Can you explain why we are having this item as a board briefing as opposed to a board vote today?
So, since the normal operating level is not changing and we're following the board approved method in calculating it, there's no need for the board to vote to change it. We're not changing the method and we're not changing the result. So we're doing the briefing as a form of transparency, of course, but no need for a vote.
Great. Just wanted that to be reflected in the record. Thank you all. Regional Director Jane Walters recently announced her intentions to retire effective on January 3rd, ladies and gentlemen, after nearly 39 years of government service. While Jane is not in the audience today, I certainly hope you join me in saluting her 39 years of public service. Jane served in many roles during her career here at Ncua, including 22 years, in fact, of service just with us. And she's been most recently as regional director. So Jane, I certainly hope that you have a wonderful retirement. And again, will you all join me in applauding her and thanking her for her service? And I think all of us as board members have worked with Jane, so I'm going to give each of my members of the board a chance to talk about her as well. Board Member Harper.
I completely agree with you. Jane is an institution at the Ncua, and it's going to be hard to imagine coming into the office at some point in time in January with Jane not being there. Jane is also the consummate professional. I have always deeply, deeply appreciated her advice, her analysis, the forthrightness in which she expresses her opinion and works to do the right thing, even under times of tremendous stress. I can remember an unfortunate day a number of years ago when we had to liquidate a number of credit unions in the Philadelphia area because of a series of frauds that affected them all together. And Jane just handled it with so much aplomb and so much awareness. I too wish Jane the very best in her retirement years.
Great, thank you. Board Member McWaters.
Thank you, Mr. Chairman. I mean, those of you who have managed people, you know what's going on here, right? You always have a group. Oh my gosh, you always have to worry about them. Like, what are they up to now? You know, keep a closer hold on those people because you know there's going to be some mischief there, and you want to limit the element of surprise. Fortunately, with Jane, she fell into the other camp. I didn't have to think about Jane. And that's great in my job. You don't have to think about people because I got enough to worry about already. So Jane did a fantastic job for decades before I arrived here. And during the 5 years of my tenure here, she's continued that way. She will be missed. And let's just hope that doesn't add someone to the list that I have to worry about. So thank you.
Great, thank you. And I hope all of our colleagues here will convey to Jane all the great sentiment that was expressed here today in recognition of her retirement. As we all now get ready to depart for the holidays, I'd just like to wish you all a wonderful holiday season with your families. I hope you have also a joyful new year, and I look forward to seeing you all here at the January board meeting in 2020. With there being no further business to discuss, this meeting is adjourned.